Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over oil, natural gas, coal, basically the energy sector, and the potential for what I consider to be an energy crisis. We're seeing this energy crisis spread over time. It's getting worse, not better. In 2019 in Asia, we first saw a liquefied natural gas crisis. We'll call it a natural gas problem. We saw a little blip in 2020 when Asia had it again. Europe had a little blip of price movement in natural gas. Then in 2021, it was Asia and Europe sucking in both of those areas with higher natural gas prices. And now we're seeing a little blip in America. And what I'm maybe suspecting or expecting is that this is going to go global. It's going to go everywhere. And it has been going everywhere. And it's not just contained to natural gas, it's moving to other sectors. It's moving to oil, it's moving to coal. And I think eventually it'll move to uranium. As the easiest things get turned on, they're turning back on coal power plants. They're probably running natural gas as fast and as hard as they can. And that was the transition fuel. That's if solar's not picking up the slack, they go first to natural gas. That was the reason why I am so heavily invested in natural gas. It's the cleanest transition fuel that we have. They went to coal next. They ran into problems with coal, and they're just going to continue to flip on power plants all over the world, wherever they can that is reliable, cheap to run. So I do think uranium is right in its path of the next one that they're going to go after. I do think that a lot of people speaking on Twitter and all these other YouTube, wherever it is, are far too conservative where prices are going to go for the entire energy sector. Maybe I'm just a little bit too bullish, but I think we're going to see far higher prices over the next few years than where we are today. So I've got some charts behind me. I'm just going to show you some things and make some observations. Now, here is the WTI crude oil and Henry Hub. Natural gas is the light blue line, crude oil is the dark blue line. And you can obviously see that these things are pretty connected throughout time, and some are suppressed over time versus oil coming back up. But overall, there is a link. And this is from 2000 to 2017, and here's the price of oil and natural gas on the right. You can see the last bull market from 2000 all the way to 2008. Nice, smooth, kind of move higher. Natural gas is much more choppy. Just to kind of give you guys a little bit of history. Now, looking on the right-hand side here, I've got the U.S. natural gas deliveries to electric power consumers. This report only went to 2017, but it went from 2001 to 2017. And what this chart is saying is the U.S. natural gas deliveries to electric power consumers. And this is the overall volume. It has been going up since 2000 continuously over time. And yeah, obviously not every single year is as high as the other ones, but the general trend is upward. And that's where I think it should be noted. And if you were to chart it over here, it goes up even more. So I just wanted to show you the general trend over time and what is being consumed at greater and greater quantities. Natural gases. Now, I put this in here. I got it from an article. It says some significant events in the oil market. When you look at all of these things, it's like slow production and increase in Asian demand. September 11 attacks, geopolitical tensions, $145 high attacks on oil infrastructure in Nigeria, along with tighter global supply. There's nothing in here talking about a real estate market and how money gets diverted differently under certain conditions, or it doesn't even talk about a commodity boom, where if we're extracting more commodities, that the demand for oil would go up. There's nothing in it. And I just wanted to kind of show that. and give you an example. And here's another one. Beginning of global financial crisis in 2008. Uh, really what's happening is the real estate starts went down. Inventories were full of real estate, and the real estate market collapsed. The financial crisis is nothing more than a crisis in real estate and is deflationary. The real estate market, in my opinion, drove the oil price because of commodities and other things and building, and it was worldwide. And then we had this large crash. It says Iran threatened to close the Straits of Hormuz, dispute over Crimea problems in Libya, or maybe they just printed a bunch of money, and a bunch of money went into the system called stimulus packages and everything. I think they were doing QE and all that other stuff back then, and maybe that's what caused this increase, and they basically ended it. Production level reached a record high in July 2015, so there's also supply backing this. Strong U.S. and Russia production, OPEC decision not to cut quotas. U.S. lifts bans on oil exports. U.S. inventories hit an all-time record high in 2017. That's why it's so low. Global oversupply 2016. They have all these other things over here of why they think it went up in terms of hurricane damage. 2016 was the bottom, I would say, of the commodity bull market for a lot of companies. And also, you can say that the real estate market started to firm up in 2016, where foreclosures started to run out, and house prices started to go up. So you're going to see a little bit of inflation. So I would discount a lot of these on the right because I think they're false alignments. The data might be fine, but I think the alignment might be a little bit false. It's money coming into the system finally. Now, here's some significant, that's usually a lot of hurricanes: Katrina, Ivan, Ike, Gustav. Weak supply and lowest record of oil or of well production. They've got all these different things in there. So not too much to say about the natural gas market outside of weather and natural events like hurricanes and stuff. Now here is some more recent data I wanted to touch on. The world's least liked commodity soars in value. This is the high energy Australian thermal coal in Australia. Goes all the way back from the last bull market of 2001 all the way to 2021. This is the last bull market that happened. You can see that it also impacted coal. Now, you can't have all these commodities all go up at the same time and take external factors that are related directly to a specific sector and say that that is the reason why it went up. I would disagree with that. It was driven by something bigger. And that's why I created this channel. That's why I dove into a lot of the data to see what is driving the herd. The herd is just humans interacting with each other. What is driving the herd to buy commodities versus something else? If you can answer that question, you can look at the correct data and make decisions based off of the correct data on where to invest. And it drove me into real estate, and specifically the cycle of real estate, which is more or less demographics. But this is what it looks like. We just recently broke out of this big pattern. And you've heard me on the channel say this before. You break out, and then what do you do next? You do like this pullback. You retest the breakout, or you pull back some. Depending on how strong it is, will depend on how far the pullback is. So I do expect a pullback out of coal, and I'm sure we're getting one right now. Now, it doesn't mean that the coal market is necessarily done. What it means is that the herd is doing exactly what the herd does. It breaks out, it pulls back, and then structurally, it'll take off. So I would suspect that coal will pull back. And if you've been on the channel a while, you're also well aware of what I do on pullbacks. I buy the pullback or the retest when it retests and firms up and then starts to strengthen again. So I suspect that a lot of these commodities, including lumber and steel and all these other ones, they pull up, and they pull up violently. they move this one here from its breakout is about a 50% gain. It's a violent move. And they're breaking these long 20 plus year patterns. And they all enter from the bottom side. These are massive patterns. And the projected move is the height of this guy here, projected upward, which is going to be way up here. Say, maybe $250, $300, something like that. And it depends if you do a linear versus logarithmic chart. And I suspect that we'll get a pullback and then a very large move higher. I think we are in an energy crisis, and the problem is getting worse. It's not getting better. That's why it's spreading from certain area or regions or countries into other areas, regions, and countries. Here's uranium. Uranium looks very similar. We are under everything's under the same market conditions, which is commodity bull market. And you can see uranium's pulling up. What happens when it pulls up? It backtests. I think we're doing a backtest retest right now in uranium, and then we'll find out where it goes after that. But I am very hopeful and remain very positive on all of these energy sectors. And uranium is still very cheap in relationship to gold. And I know a lot of people say, why does that matter? What does gold have to do with anything that's in energy? Well, it's just a monetary accounting mechanism. It's an inflation adjustment, psychological level that gets put into the price. So if the psychological level of a commodity to gold gets to a certain point at market tops, and it always hits that point or very close to that point every single time, then we could conclude that if gold went up and it has accounted for the increased money units in the system, that if it were to hit that same psychological level, the markets, that a new price at a higher level is going to be attained. We're not going to hit 140 because in 140 in 2007, it didn't have the deficits like we do have today. And gold was a much lower price at that time versus today. So I would suspect that uranium would go far higher than $140, especially in an energy crisis and especially when money has been dumped into the system like it has. I would just add a zero to the price that's currently there, maybe $460. That sounds much better and much more closely linked to what history would suggest the price would be. Now, I'm going to read some stuff. I have some articles here. It says Blackstone CEO Steven Schwartzman warned Tuesday that high energy prices will likely set off social unrest around the world. He said, "We're going to end up with a real shortage of energy. And when you have a shortage, it's going to cost more. And it's probably going to cost a lot more," the private equity billionaire told CNN. U.S. oil prices climbed above $85 a barrel on Monday for the first time in 7 years. Gas prices continue to creep higher, nearing $3.40 a gallon nationally. Natural gas prices have likewise skyrocketed, especially in Europe and Asia, prompting the shutdown of factories. You're going to get very unhappy people around the world in the emerging markets in particular, but in the developed world. Schwartzman said at a future investment initiative, "What happens then, Richard, is you've got real unrest. This challenges the political system and it's utterly unnecessary." Says part of the problem, Blackstone billionaire said, is that it's getting harder and harder for fossil fuel companies to borrow money to fund their expensive production activities, especially in the United States. And without new production, supply won't keep up. If you try and raise money to drill holes, it's almost impossible to get that money, Schwartzman said, adding that this is happening on an extremely wide-scale basis. And I've got a quote here. It says, "Inflation is definitely more than transitory. The energy crisis is amplifying inflationary pressures as the world economy recovers from COVID. Not only are gas prices costing consumers more at the pump, but the government recently projected that home heating costs will rise sharply this winter as well. Businesses are also getting hit by higher energy prices." And looking at this last one, it says, "Short-term policies related to environmentalism in terms of restricting supply of hydrocarbons has created energy inflation. And we're going to be living with that for some time," Fink said in the conference. The energy crisis is one reason that BlackRock boss doesn't think inflation is just a short-term problem, as the Federal Reserve and White House have argued much of this year. Inflation is definitely more than transitory, Fink said. And what I have below is the current natural gas and oil price. And we're seeing the same type of characteristic in natural gas and oil as in coal, uranium, and all the other commodities. We were in this channel, trading in the channel since the last bull market of natural gas, which was 2008 in the crash. We've been in the channel and we just broke to the upside for natural gas. What happens? We usually pull back and do a retest, and maybe we go way up before pulling back, but it's broken out of its channel to the upside. And the oil price, this is a long-term oil price since 1950. We came on up and we created this channel that oil's been trading in. And we've had these downtrend lines inside of the channel. And each time they've broken it, they've gone to the upside of the channel. So you've broken this trend line here, it went to the upside of the channel. Broken this trend line here, went to the upside of the channel. And we're just breaking this downtrend line right now. And I'm going to go in another clip and do some further analysis of this pullback versus this pullback in oil and show you that it's exactly the same. And I don't know why someone would suspect that we would have a different outcome having the same exact pattern breaking its downtrend to the upside. But as far as I can tell, everything that I can tell is that an energy crisis is in the world. It is spreading around and it's getting worse. Now, there's other ramifications to this energy crisis that I probably can't think of off the top of my head. I mean, it's going to impact a lot of things. Energy is used in absolutely everything. Commodity, oil, is the number one commodity in the world. It's used in the most items. So not only are your input costs of energy going up for everything, but if you have energy shortages, that may impact a whole bunch of different things. And I don't know if we've ever had an energy shortage that would include potentially transportation fuel and electricity at the same time. So I'm not exactly sure how everything's going to be impacted. Is it going to be impacted by shortages everywhere in the world? Is it just higher prices and higher prices will cure it? Is this going to spark a massive amount of money spending into renewables? Because that seems to be the way governments are going. Are they just going to triple, quadruple down on the route that they've already gone? Are we going to have more investment in hydrocarbons? Are we going to have a mixture of everything? I don't exactly have the answer for you, and I'm trying to think through it. But my first intuition is to be directly invested in hydrocarbons. And that if we see these things tank to the downside and they go back and do retests. Now, another thing I want to touch on is they're going to say stuff. People, hedge fund managers, whatever it is, they're going to say that when it comes back to do the retest, they're going to say, look, it's crashing. Told you everything's going to fix itself. I don't think that's crashing because of the actual problem being fixed. I think it's crashing because the herd mentality does that retest. They're taking profits, they're doing whatever. It breaks out, gets new highs, it always comes back, it seems like, and then it takes off. Knowing all of the reasons why people would be selling, kind of difficult to know all those reasons. But rather than me knowing all of the reasons or fictitiously assigning stuff to it, what we do know is that it likes to pull back. Platinum's done the same thing today and all that, but it does that, it hits it, and then it takes off. And it never, I call it the kiss of goodbye. It gives it a goodbye kiss and says, goodbye, resistance line, I'm not going to see you again. And then rips it. So the energy crisis, I think being directly invested in it is a direct way to play it, quite obviously. Now, if there's shortages and there's things that we can't grow the economy, and let's say debts have been growing, but they can't go backwards. So if the economy shrinks, remember, energy is driven by the economy, or the economy is driven by energy, sorry. The economy shrinks, and your debts don't shrink. That could be interesting. I mean, this could be a very inflationary period tied with a deflation or a bust in some of these problems. It could be a large boom and then a collapse, and then it goes again and again and again, just like some of these guys have predicted in the peak oil world, where if you hit peak oil and you have energy problems or shortages, it'll grow and expand, and then have a bust period where things kind of collapse, and then it does it again because you have a structural shortage in the system. Now, I don't know if this is going to be a structural shortage. I don't know if it's driven just by investment, but we'll see how this plays out. But I think higher prices are right around the corner. And I'm playing it directly through oil and natural gas companies, the exploration companies. I know some of the people are looking at energy service companies. Energy service companies derive their money from increased spending. And if the companies are much more constrained on spending and they can't get the money flows from uh, from lending, they may be constrained on how much they can spend for energy service companies. So the price of oil and natural gas and all these commodities will go far higher, but I don't know if it'll all be directed to the energy service companies. And that's why I favored the exploration companies. I don't really favor the oil royalty companies because I want to see something that really grows their base, their oil exploration, their reserves. And I like that a lot of them are 50-50-ish natural gas, oil. So I've favored the small cap oil and natural gas companies because they can grow production. The bigger ones can't. So it's I think the best play for the oil and natural gas problem are the companies that are smaller, quite agile. Once their revenues and cash flows start going up, they can reinvest into the company, grow reserves, and just keep going. I think that's much more difficult in the larger companies because one, they can't replace the reserves. The reserves are going to decline. It's hard for all of these companies to gain access to lending, and everyone on their board and what is now on their boards of these large oil companies, they don't want to be oil companies anymore. So I'd rather go with the small guys who are more focused on growing their production and cash flows than maybe some of the big guys that are trying to exit the oil sector. And I think this problem is going to persist for some time. I don't think it's going to be fixed in a year or two. I think it's going to go the entire bull market of commodities. And I think this alignment is perfect with the expansion phase of real estate, with the Federal Reserve printing all this money, and with these chart patterns behind me that are all breaking to the upside, where the valuations are for commodities in relationship to stocks. I mean, everything's in alignment here. So we could see a big move. And if that top line behind me in that channel doesn't hold, I don't know where that price is going to go. it's We'll see. But I just wanted to touch on this, the energy crisis. I think anywhere in energy is probably going to be a good spot to be for investment over the next 5 to 10 years, probably. If you guys like this analysis, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.